All right, ladies and gents, no major headlines, no shockwave economic report, but beneath the surface, here we go. Builders are quietly making some big moves and smart investors are watching very closely. Today I'm going to break down what current builder activity reveals about the future of U.S. housing and how it can guide your next flip or rental acquisition. If you want weekly insights like this, plus under-the-radar flip deals across the country, make sure you subscribe to the Deal Watch. It's our free newsletter for real estate operators who actually move on data. Click the link down in the description below. You can jump on that list for free. All right, let's start with the obvious. Mortgage rates aren't doing much this week. The bond market nudged slightly, but nothing dramatic. Rates eased a hair, but we're basically in a holding pattern. That's good news for flippers. It means a window of price stability before the next Fed move or jobs report throws a wrench into the works. And yes, it looks like we might finally get a rate cut in September, but more on that in a second. All right, here's where it gets interesting. Builders are pulling out of overheated markets, Miami, LA, Orlando, Tucson. In these cities, builder market share is down double digits. Why? That's simple. Prices overheated, buyers vanish, builders are cutting their losses. If you're flipping in those metros, be cautious. Supply is thinning not because demand is roaring, but because developers are backing away from risk. But here's the real opportunity, where builders are ramping up. Check out these metros where national builders are doubling down. Oklahoma City, Atlanta, Salt Lake City, Greenville and Charleston, South Carolina, Punta Gorda, Florida, Philly. These areas are attracting fresh capital and new construction, even in a high-rate environment. That's a massive signal. When builders start betting big, it means one thing. They expect stable demand. And for flippers, that equals pricing support, buyer traffic, and exit strategy confidence. So what does that mean for pricing? Expect stability in builder-favored markets and declines in retreat zones. Builders adding inventory doesn't necessarily mean oversupply. In these target markets, added inventory may stabilize pricing by meeting growing demand, not crushing it. If you're flipping in one of these growth zones, it could mean stronger comps, faster resales, and better appraisal support. But in contraction markets like LA and Miami, buyer pullback and vanishing builder activity could signal trouble ahead. Okay, so zooming out, how do tariffs and corporate earnings play into all this? Well, earnings from companies like Coca-Cola and GM just beat expectation. That signals resilience, not collapse. Tariffs haven't tanked the economy yet. And meanwhile, inflationary pressure is easing. Oil is trending towards $65 a barrel. The 10-year Treasury yield is slipping, and the bond markets are steady. Translation, the Fed is likely to cut rates in September. Markets are betting 50-50 on it, but all signs point towards easing. That is your opportunity as a flipper. Buy now in growth markets, lock in favorable pricing, and ride the next affordability bump when rates drop. All right, you guys, so not sure where to invest next? The Deal Watch has you covered. Every week we track the exact zip codes where builder permits are surging, off-market properties with flip-ready margins, early warning signs in contracting metros, real-world comps, inventory stats, and risk flags. No fluff, just data that moves the needle. Just click the link down in the description below, and you can hop on that newsletter right now for completely free. All right, folks, see you on the next one. Bye.